All right, we'll get the show on the road now. What's going on, everyone? Good morning, good afternoon, good evening, wherever you are. My name is King Wabi on behalf of Because Bitcoin, and here we are with another edition of Crypto World Radio, where we have all kinds of guests from the crypto Twitter community, projects, or individuals developing any kind of software when it pertains to the digital asset space. And today I am joined by our fellow community friend, Feel Payne. What's going on, Payne? And our special
What's going
guest.
on, Wabi?
What's going on, brother? And our special guest for today is none other than the big dog himself, Magoo, who's an excellent advocate for the Bitcoin space and an individual that I've honestly had the pleasure of learning from over the last 6 to 8 months. A great speaker. And just a reminder, if you're listening to us from YouTube, be sure to like, comment any sort of feedback, click the subscribe button, and turn on bell notifications so that you can be updated with our daily content streams Monday through Friday. We have a morning show and an afternoon show. And we have Market Talk on Twitter Spaces, and then myself with Crypto World Radio at 7 p.m. Eastern Time. But due to time zone differences, anytime we do have special guests, that could vary, could be 9 p.m. Eastern Time, or later on, later before, more in the daytime, like we did yesterday with Matt Coons, who's another amazing advocate and speaker in the Bitcoin community. So, yeah, and be sure if you're listening here on Twitter Spaces to go ahead and follow the Because Bitcoin page. I'll be doing all of my Twitter Spaces when it pertains to crypto specific stuff on their page Monday through Friday. And go ahead, check out their website so you can be updated on daily articles from our writer Nick and Valentine, who are excellent writers. And if you click on the bio here on Twitter, you can have a link to our Discord. We have almost 1,000 community members now, and I'm always there active on the voice chat. Love engaging with you guys in the community, whether you're BTC exclusive or you like crypto Ponzi's or NFTs. I don't care. I enjoy connecting with you all. And overall, I'm here united with you guys tonight via the power of friendship. So let's get the show on the road. Magoo, how are you today, my man? It's excellent to have you here. Um, I've been meaning to have this for a while now, dude. Huge fan of yours. Let's get the show started. How are you today, my
Doing
man?
good. I don't have a happy meal in me, but I did just eat a nice foot long turkey club from my local deli. So it's I'm feeling good.
So Magoo, brother, I don't think we've ever had the chance to formally speak. So I guess we can start this off by saying, how did you find out about Bitcoin, and what has attracted you to the space, and what has you active in the space after each and every bear market? How's that been like, brother? Like, what took Magoo from not knowing about the space to knowing about the space and being one of the early pioneers in the space?
So I guess the thing that got me into it, obviously, I kind of fit a specific demographic that kind of introduced me to Bitcoin pretty early. One, kind of my age demographic. Two, my profession as well, and what I was studying in school in computer science. At the time, I was doing my master's degree at the time when Bitcoin was released, and realistically, I was introduced it by someone else in my class in the winter of 2010, and then we kind of learned about it a bit, but really, honestly, like from day one, we actually started mining because this individual basically told me this was going to be the next world currency. And even at the time back then, I didn't believe him. It was just kind of a fun thing to do. Um, and we started mining in 2010. I won't get into the details too much with that because there's some off spec stuff there. Um, but realistically, been on and off Bitcoin for, I guess, at this point, it's been 12 years. Been super full time since 2016, though. From 2010 to 2016, it was kind of on and off. We mined in 2010 and in early 2011. Kind of walked away for a bit in 2012 and 13. And then the Bitcoin price, everyone knows, in 2013 and 14, well, 13, it kind of went on a roller coaster, and that kind of pulled me back in. And then it crashed in 2000, late 2013, 14, with Mount Gox. And then kind of went kind of silent a bit until 2016, and then I actually started working full time in the space since 2016. And have been working full time in Bitcoin ever since. And so that's kind of like my backstory, realistically, how I got involved. And as of late, like the bear markets of 2000, I guess 17, or I guess really 2018 and 19, and then now this bear market of like kind of 2022. The things that keep me going it is honestly the absolute. I don't want to say it's entertaining because well, it is the entertaining of new people, new blood, I'll call it, getting injected into the space, and every single time the same thing happens over and over and over again, where people get overextended, they get greedy, you see these bubbles and then it deflates, you see people disappear, and then you see people actually like kind of lose their minds, and they really kind of go sour if they were milk, and that's been pretty entertaining to me. Like, because realistically, I'm pretty steady. Like, I've just been building since 2016 at this point, on a couple different projects and kind of some open source stuff here and there, back in 2016 and 17. But ultimately, at this point, it's all about the memes and the separation of state and money, which has been kind of a real big focus for the last 2 or 3 years, of mine specifically. But that's kind of just my overall backstory. Nothing too exciting.
For sure, man. Thank you for that answer. And do you think, in regards to this bear market compared to the 2018 bear market, do you think we've retained more social capital relative to that bear market? And by social capital, I mean people that still have eyes in the market or that have remained solvent. Because as you know, and many people in the audience know, back in 2018, the derivatives market wasn't as big, so the only option you really had was to dump everything. And within 3 months of that 20K top, all altcoins were already down 90%. And then they proceeded to lose another 90%. And the space was just super quiet. And all we really had is like that whole backed ETF thing. So the question is essentially, do you think this latest bull market that we just came about, at the very least, added more eyes into this asset class?
Yeah, I guess when it comes to social capital, we can talk about capital in general, but like when it comes specific to social capital, we brought on a lot more. I'll just call it brain power, right? Because like the social capital, you have people that are just coming in, like the normies, and they're just speculating and they're just interested in it. And like that has been higher and more every single cycle that's kind of happened. Whereas back in 2010 and 11, it was a completely different crowd, and then 14 it was another completely different crowd, and then 16, 17 was a different crowd, and then now 20 and 21 a completely different crowd, and you have people that are staying along. But one of the things that I've noticed specifically with this past cycle is the intellectual capital that's flowing into Bitcoin, specifically, not only from the technical, I'll just call it technical background, people that are software engineers, computer scientists, um, those people, and also people in traditional finance as well, and just traditional, um, I'll just call them traditional sectors and jobs, have also been flocking to Bitcoin over this past cycle. And that's actually one of the things that's making me the most bullish. Like, because at the end of the day, like paying attention to price is fun. It gets the engagement. It makes you the monies. But this last cycle, there's been a lot of intellectual capital coming into the space and not wavering, even with the prices going down, and those people continuing to kind of double down on their interest and just their investment, not only with money, but also with time into the space. And that for me is really what kind of signals to me that this is not um that it's different this time, because like even last bear market in 2018 and 19, and even most of 2020, you had people like BitBoy and all these people. Like BitBoy was making TikToks about like secrets of the dark web part 4, secrets of the web dark part 5. Like just like people lost complete interest in crypto and Bitcoin in general, because it was a long drawn out bear market, and people just lost interest, right? Like there's really nothing to write home about in crypto at all from 2018 to mid 2020. Like the halving happened, and then that's when we started to uh, kind of start picking up. Obviously, COVID happened as well. We had that kind of like that forced liquidation cascading event that brought us down to, I think, somewhere in the 3,000 areas. It's different on every exchange, but there wasn't really too much to write home about in that bear market. And a lot of people lost interest. Like there's a lot of people that were around in the 2016-17 bear bull market that just disappeared completely, right? It's just like it happens every cycle. And then it's happened this cycle again, where you've seen all of these, I don't want to call them bandwagon jumpers, but essentially if you can't survive one cycle without like actually just staying, then like you're really just a tourist, right? People that can't take the emotional strain of the upcycle. They're there for the upcycle, they're in the excitement, and then all of a sudden it starts going down, and then they disappear, right? But overall, like back to the original question, like there is a lot more social capital that has come into Bitcoin and stayed, and a lot even more importantly, I don't care about the social capital, but it's the intellectual capital that's really going to pull this industry forward. But also that could be another in another sign, an indicator that we haven't bottomed in terms of the price, right? Because there isn't that, I'll call it void, or that feeling of despair that was around in 2018, 19, and also what was around in 2014, 15. Um, like it hasn't hit that point yet in Bitcoin's price and just the whole kind of environment. So we'll see what happens there. But overall, we have attracted a lot of very smart people that are just getting into the space now, that are definitely adding to the movement, I'll call it.
Magoo, and I saw a tweet that you had put out almost 2 years ago, I believe, when we breached 20K with Gusto. We were trading around 25K, and you had mentioned every single entity that has gone insolvent over the last year, saying how they're essentially going to be wiped out. And given that we're talking about attention on the market and there being a lack of void, back then, did you think that when all of those entities essentially rug the market, did you think we would reach that void, or did you think that we would be very similar in the market environment when we were consolidating at 6K? Because that's what ultimately this range over the last 6 months has shown me. We're simply still in the same 5, 6K range. So for you, Magoo, what is that void? And back then, did you think when all these entities go down, did you think that the social capital that has remained in the space would have still been here? And it's also ever growing. Like when you click that Twitter Spaces button and you search up BTC or Bitcoin, there are literally dozens of spaces going on throughout the entire day.
Yeah. So ultimately, when I made that quasi prediction, and I didn't like smoke some DMT or rub my crystal ball. Those were just kind of the three main entities that I seen being rather speculative and really pushing the envelope when it comes to reapothecating Bitcoin. They were making their entire business model around that. And that's why I named those three companies. And it just happened to be that each one of those three companies, two of them now filed for bankruptcy. One of them paused withdrawals and may file for bankruptcy. That being Genesis, Celsius, and BlockFi. Um, Ultimately, I knew the price would have to be a lot lower than where whatever the peak was, just because I think in that same thread where I made that prediction, I also explained why it was going to happen, and I explained basically all it's going to take is the first liquidity event, like the liquidity crisis in Bitcoin. I didn't know where the price was going to be, but I knew that there was going to be a liquidity crisis, meaning there's like just realistically like the macro environment was going to turn eventually, and there's going to be a lot tighter conditions for capital, the cost of capital being higher, and Bitcoin still trading and behaving like a risk asset. There is going to be a lot of redemptions in terms of loans and people wanting to get their hands on back of their Bitcoin, and their liquidity profile of their lending book was just not going to be able to accommodate that because of how aggressive they were, and not only how aggressive, but like how irresponsible they were with their loan book. Because I had pretty intimate knowledge on how all three of those companies were actually trying to generate yield. And at the time, they were generating yield from the GBTC premium ARB trade, and that was obviously we all seen how that ended up. And ultimately in crypto, there's no lender of last resort. There's no FDIC insurance. They can't go to the Fed window. They're just, if they don't have the assets, they don't have the assets, and they're going to be screwed, right? And just the whole environment of like the lack of regulation that we've seen this cycle, it was pretty easy for me to make that call at that stage. What a tougher call would be at this stage would be pointing out the next financial institutions that go under because of Bitcoin reapplication. And mark my words, it's going to happen again. It might not happen to the same extent with some of these like fly by night like crypto companies, but there is going to be a time in the future, and it might not be off until it might be way into the future, where one of these traditional financial companies, TradeFi companies, is going to be in the business of lending and borrowing of Bitcoin, and they're not going to be able to make their payments. What I mean by that is there's going to be runs on banks, right? Because ultimately, there's always been runs on banks throughout history. And that's what you've seen kind of in the Great Depression and a couple other things. I don't know if you guys, I even quoted this. I even quoted this in this thread where I made that prediction. Is like once upon a time, like the movie, there's like a bank run. Like there's been bank runs all throughout history, and it's going to continue into the future. And so, realistically, all that these firms can really do is put roadblocks in place for individuals not being able to actually self custody or withdraw their Bitcoin. Or else those companies will go insolvent. And there is going to be more companies in the future that probably have to get bailed out or go under because of their irresponsible lending when it comes to Bitcoin. So ultimately, I knew the price would have to be pretty goddamn suppressed for that liquidity crisis to kind of like happen. Like the liquidity crisis would cause the price to go down because it's a risk asset, and then people would want to get their hands on their private keys, and it would cause this whole kind of dominoes. I think I even used the word dominoes in that tweet, which is exactly kind of what we've seen here. And that will happen again in the future. History doesn't repeat, but it rhymes. So something similar, very similar, will probably happen somewhere off into the future. But where we're at now in terms of like the price action, we've been floating like even since like when Luna blew up, we wicked down to I think 17,500, and we're realistically only $1,000 below that. Obviously, there's been, if you're a technical analyst, there's been some key resistance and some key support, kind of like slowly but surely we're chopping our way down. And just where we're at in the current macro, it's going to be very hard for us to kind of find a footing here. And we probably will continue to go down here in the next month or two.
Magoo, and when it pertains to bailouts and the entities that you had mentioned on a prior space where we had connected, you had mentioned the model that Coinbase does for their institutional clients called Coinbase Prime, and essentially it's even if the company that you hold the underlying asset in were to go under, you still maintain ownership of that asset, right? So when it pertains to things like Genesis, would those clients be insured their rights similar to Coinbase Prime? And moving forward, how do you see that model being implemented onto other exchanges, such as your everyday Binance user, or potentially with Gemini, given that they are experiencing some liquidity issues and they want some sort of bailout from what it seems. It's not really looking good for their earned customers that have a total of what I believe is close to $1 billion. So if we can get your thoughts on that as well, that would be
Yeah,
incredible, because I just found out about that model from
yeah.
Coinbase,
So
and many people aren't aware of it.
yeah, so ultimately, let me just kind of explain like the average retail experience and what that means legally for retail investors that have Coinbase accounts. So essentially, if you're a retail investor at Coinbase, you're an unsecured creditor, meaning when you deposit your assets to Coinbase, they actually live on Coinbase's balance sheet, meaning that they have the rights and the privileges to do anything with those assets that they deem fit in today's regulatory framework. And if Coinbase were to go bankrupt, theoretically you're an unsecured creditor, and you are going to be one of the last people that actually be able to actually recover any funds, right? That's how it currently works at Coinbase Retail. And obviously, you can see how that is a very nefarious type of model for retail who is putting money on Coinbase thinking that it's safe. Even if Coinbase is a functionally solvent company, legally, you are putting yourself into pretty iffy territory when it comes to like the sovereignty of your assets. Um, so there is a product called Coinbase Prime, which is more for their high net worth individuals, their institutional investors, where you have segregated funds not only on the blockchain, like so you have individual auditable addresses on the chains that you're looking for and what assets you hold, but also legally, you're not an unsecured creditor or creditor to Coinbase. Your assets are on your own, and I'm not sure exactly Coinbase Prime product. I'm not sure if it's a trust, but basically your assets aren't put on the balance sheet of Coinbase. Unfortunately, that product comes at quite a cost compared to just depositing your assets in a regular Coinbase account as a retail investor. And the reason why it costs so much is because there's a lot of legal fees and operational costs to having your assets set up in that structure where it's either in a trust, and it's audited the way that the trust needs to be audited, and also the operational cost of dealing with those assets. Like one of the things that these exchanges and Coinbase does to make things very efficient in terms of operating coin movements is they commingle them, right? So they commingle them, and they're able to do treasury management a lot more efficiently when they can do whatever they want with those coins, and they can move some into hot wallets, they can move some into cold wallets, and they have an operating wallet for that's a hot wallet for daily liquidity and withdrawals. And so they can manage those UTX, let's just call it for Bitcoin, they can manage those UTXOs a lot easier than if you had it in the Prime product, where you're actually having to do on-chain, I'll just call it on-chain settlement for a lack of a better word. And it costs a lot more, not only to not physically, but to do that on chain, but also operationally, because some of these custodian custody products, whether it's Gemini's custody, Coinbase Prime, Genesis custody, BitGo, there is a very extensive procedural process put in place that has your segregated keys in a very secure manner. Like I know some. I'm not going to talk to specific ones, but I know some custodies they actually keep their the private keys, or not the actual private keys, but they have devices where they keep those private keys, and those are kept in bank vaults, or they're not kept on the same site where the transactions are made. Some are stored in bank vaults, and then the location where they do it. So they have to actually send people to go pick those up, take those devices, bring them back just to send those transactions. And so it's a very costly when it comes to operationally, and so that's why you're paying for that. Not to mention like the legal costs it costs to have all that stuff set up in the structures that it needs to be, um, if they go bankrupt, and for you to kind of have assurances that those are your coins, according to the law as well. And we can get into, like, I don't know if you want to know the prices, but like the cheapest that you could probably get out of all of them. Some of them have different price models. Gemini's is basically a bips per assets under custody. BitGo is monthly subscriptions, and they have different tiers. Genesis is monthly subscriptions. They have different tiers. Coinbase Prime is a little bit different depending if you're an institutional or high net worth individual, depending on your contract negotiations. But you're talking about spending at the very minimum 15,000, well, probably $10,000 a year if you're a high net worth individual. And then you could go upwards of like 20, 30, $40,000 a year, obviously depending on how many assets you have. And so there's a lot of different price points there, but unfortunately, it's a really high price point, when it comes to, retail not being able to do that. And honestly, some retail, if you wanted to go to probably some of the highest regulated custodians out there, if you go to like Anchorage, who's actually kind of regulated as a bank, they don't even take people. You have to be a bona fide institution to have an account at Anchorage. And so you're just kind of left out in the cold when it comes to, having that type of security. Um, and that's unfortunate because at the end of the day, I understand why some people are reluctant to have basically being a self-sovereign individual and storing your own private keys. There's a lot of reasons, why you might want to use a custodian, a qualified custodian that's probably operates, at least if you're in the United States, operates as a trust. Um, the why the people would want to use that, and it's just unfortunate that the average person, I'll call it, just can't afford it. Because like if you're only holding, let's say, $100,000 in Bitcoin, it doesn't make financial sense for you to be spending, 10, 15, $20,000 a year on your custody solution, and so you're left having to use the regular custody solutions, which usually exposes you pretty badly when it comes to not only, if there's insolvencies, but also, operationally, as well. Like you just don't get a good product, right? Because at the end of the day, like when you put your stuff at Coinbase and you're just a retail, that's not necessarily in cold storage, right? Like they have a cold storage, and then they have a warm storage, and then they have all of this operational stuff with moving money in and out of each of those, but you don't have a bona fide address, right? That's another good thing about having a bona fide address where your funds are actually there. You can check on the chain, like, oh, I have one Bitcoin and it's at this address. Where you have it in a commingled solution with other retail, you have no idea if your shit is there or not. And so I don't know how this is going to change in the future, because I know how expensive and costly it is to actually offer this type of a service. But I'm hoping some regulation comes out, that makes it more advantageous, um, for retail, to have a solution like this that's not, going to cost them an arm and a leg.
Magoo, so currently, right now, on something like Coinbase, since we're just talking about that, currently the bonds reflexive to Coinbase are paying out close to 20%. So it's essentially screaming that, there are some potential roughhousings going on within the company. And my question to you, and I posed this similar thought to Matthew Coons, who was a guest yesterday, given that situation, right? Do you think something like maybe a BlackRock or an Anchorage, like you had mentioned, would proceed to potentially, quote unquote, be in a situation where they make love, and essentially that institution is now on the back end for the customer when it pertains to Coinbase, given that they are the largest retail platform. But the fact of the matter is, they're only a profitable company when we have a bull market. And Brian Armstrong did hire someone for $1 billion to build an NFT platform that's essentially just Instagram 2.0 with some quote unquote Web3 features. So, what sort of solution can you see for this development going on within Coinbase? Do you think that maybe Anchorage or perhaps Fidelity, which to my knowledge has now provided some of their clients to be exposed to spot Bitcoin?
So I guess just to go back to the Coinbase stuff and kind of their debt, for lack of a better word, trading on cents on the dollar. From my understanding, I don't think the discount in their debt has so much to do with like their their possibility of them being insolvent. Like all of their stuff's publicly available, and them doing funky stuff. I think it has more to do with the functionality of all the debt that's been issued is unsecured with no covenants. And what that really means is that it can be primed with secure debt placed on top of you, which means that you could get rugged as a debt. Like everyone knows, like if you're an unsecured creditor, and you have coins deposited at Coinbase, you're at the bottom of the pile of if they go Chapter 11 and you need to basically get some of your money back. Like you're going to be one of the last people to, and you as you go up that stack, and who has, I'll just call it liquidity preference, even though this isn't the right use for that word. Um, at the end of the day, it's who legally has the right to get paid first, essentially, right? And obviously, the debt owners have a legal right to get paid before the equity holders and also the end customers, unfortunately. But there's even ways that you structure your debt, and that's what I'm talking about when it comes to like unsecured, and then basically secured debt. And so all that stuff, I believe, right now has been issued with no covenants. And so realistically, I think they could issue more debt that would then be put on top of you, and then you would not be on top of like the ladder in terms of like if anything ever goes bad with the company. And I think that's why it's probably trading at such a discount of where it is today. But that's just my 2 cents. At the end of the day, the market kind of will be the market. But when it comes to the future, um, and how I think or how I would want kind of custody to be solved. One, you're going to continuously see both of these models being used, like one being unsecured creditors and then one being kind of like these are your assets. One of the major things that's missing right now is just the communication of most retail individuals that are on Coinbase have no fucking idea of what we're talking about. And nor should they. Like at the end of the day, retail investors are retail investors for a reason, but it needs to be very clear to them what the risks are, and that needs to be advertised to them about before they start using services. There's a reason why you can have a Coinbase account and not have to pay anything for it, right? Like you're the yield, like in a lack of a better word, they are benefiting you being a customer, meaning you're adding liquidity to them, right? And you're not having to pay for the service. So it's the same thing when you pick up Instagram. There's a reason why you don't pay for Instagram is because they're marketing the shit out of your data and they're selling it. And so when it comes to Coinbase, that's fine, but I think it needs to be very clear on what product that people are using, and basically outline all the risks of what you're actually using as a product. But I also think there needs to be other solutions where you do have places where you can deposit your Bitcoin or your crypto or whatever, that you're not automatically an unsecured creditor, right? Like that you are, those are your assets, and what needs to happen for that to happen. Like technically all the stuff behind the scenes that already exists. Where this has to kind of come to fruition is on the legal side, I think, of having regulation put into place to force these companies to offer said products where those assets that are being kind of deposited on behalf of a client or by a client are legally maybe not insured. That's a bad word because that's a different story. Let's talk about that next. But those assets are that client's assets, and if there is a Chapter 11, those assets go back to that client. It's not exactly like FDIC, but something to that accord where retail can deposit into a custodian or to a service, and they know that their money is good, even if that company goes under. I don't know how you would want to legally structure that. I'm not a legal expert, but that's what I would like to see, um, obviously. And then you're still going to see kind of having the premium services from all these actual bona fide custodians. Um, well, you pay a pretty premium to get those services. But one of the things they floated out there, it might have been half a year ago now, and I don't know if it was Gensler himself, but they were even floating the idea of regulation at making the custodians separate from the exchanges. And so, like when you're coming from a traditional TradFi background, you have qualified custodians, right? Then you'll have like your prime broker dealers, you'll have your exchanges. Those are separate, and those assets aren't actually being stored at the same place, right? So there's a lot of conflict of interest, and we've seen this play out with FTX, where their entire derivatives book literally ate in to the rest of their business, right? And that was allowed to happen for many reasons. But one of the fundamental underlying reasons why that happened is because you had one company dealing in multiple different aspects of quote unquote the digital economy. You had them doing futures with derivatives, you had them doing spot trading, you had them doing custody, right? And so they floated the idea of like, hey, there needs to be pretty clear cut lines between qualified custodians and places that are financial services, whether it's a prime broker dealer, futures, derivatives, whatever it is, but that's completely separated from the actual custodian. And I won't say who, but I'm working with firms in the custodian industry that they're signaling to me that that's the way that they think this is going. Because just to kind of give one example, I'm working with a custodian, a qualified custodian in the digital realm here, and they also have an OTC and a prime desk. And before, their OTC desk was like directly hooked into their custody business. You do a whole bunch of different stuff with that. But now they're starting to build off walls and trying to make rivers between their prime services and their custody business. And that's causing friction for me, and we're working through that. But they're creating a separation between the qualified custodians and the prime. Even if you look legally, in the corporate structure of how a lot of these companies are orchestrated, or not orchestrated, but like their corporate structure is, a lot of them now, they're very segmented with like their qualified custodians are trusts, they're segregated, they're separate, like legally separated. Their prime desk, their prime services are completely segregated when it comes to the corporational structure, and they're not allowing certain information and certain things to happen between those. Like, sure, you might have a conglomerate company that's kind of overlooking both of those, but they're really, at least in the last 6 months, I've seen a huge push to kind of draw a line in the sand to say, hey, this is company blah 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 custodian, and this is company blah 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 prime desk. And even within the prime services, they have segregated companies that who are your counterparty when it comes to, let's just call it your trading, where you're settling with a completely different entity altogether. And so that may be one of the routes that they take to kind of really make sure that you don't see an FTX happen again, where it's just not even possible because the custody business is completely segregated from any of the other activity that happens.
Magoo, so if I'm a retail consumer, right now I can sign up for a Coinbase account or a Gemini account and a Kraken account in under 5 minutes. Given the situation that we're facing, it really looks like not only are we experiencing a .com kind of bust where a lot of these quote unquote crypto projects are really just zombie companies, and individuals in the mining business were just hooked up on leverage on leverage on leverage um, to get an access over that field. And also 2008 with things like FTX, Celsius, and what have you. What does this market look like for the retail consumer being onboarded, say December 2023, Q1 2024, when all of this subsides, and of course we have other macroeconomic factors potentially, such as rates being below 3% and all that stuff. What does all of this look like at the end of the road for the retail consumer wanting to get in the market?
So I think by the time the next bull market comes around, and I think the next bull market's not happening until 2025. And I'm not saying the price isn't going to recover till then, but I mean, like, until we get to that plateau where we're going to have that next leg up, I don't think it's going to be until 2025. And I think ultimately at that point, you're going to see whatever pans out here in the next 6 to 8 months. You're going to see a lot of tradfi companies come in here and buy assets for pennies on the dollar to kind of bootstrap their entrance into this market. And so realistically, I think by the next cycle, you might be able to buy your Bitcoin from a JP Morgan or a Wells Fargo or a Goldman Sachs, right? Like, you already have Fidelity deep, super deep into this industry. Franklin Templeton's entering this industry. Just massive asset managers in general after you have NYDIG. But I think now you're going to see the traditional TradeFi banks and investment banks really kind of start bolstering their services. And I think most retail people might end up actually buying their Bitcoin from banks by 2025. And because ultimately there seems to be a battle right now between who gets to regulate crypto. Like, there's been a lot of political bolstering between the SEC, and a whole bunch of other regulatory organizations of who wants to do it. You see Anchorage. Anchorage is going down the road where they're actually be regulated as a bank. They're regulated by the Office of Controls of Currency. And so they're going down one road, right? And they have a lot of stipulations on, and that's also why Anchorage can't deal with even high net worth individuals or even ultra high net worth individuals. They have to work directly with institutions. And there's a lot of stipulations of what they can do because they're regulated as a bank. And then you see the SEC coming in as well, and they want to regulate everything as a security, right? And a lot of these places, like Coinbase, has been trying their very best because they want to be regulated by anybody but the SEC, I think. But ultimately, I think the SEC, a lot of these coins, if you can call them coins or tokens, I think probably 90% of them are going to be deemed securities, because it's very easy when you look at the Howey test or even how some of these things operate. Like, look at ApeCoin or Uniswap, uh, all of these other things, these DAO tokens. Like, literally, if it's a DAO token, it's pretty fucking simple to me to say that that's a security. And like, ApeCoin is even more special because there's nothing built, and you're literally investing into a group. A group of people are investing into the work of others to kind of deliver a return on your investment. And then there's Uniswap, which is another DAO token, which theoretically in the future you might be getting revenue from the exchange fees, right? And so, like, I think 90% of these tokens are going to be deemed securities. And I think most of these exchanges will probably have to be regulated as a securities exchange. I just don't see any way around that. How that really pans out in terms of regulation between all these kind of regulators, that's going to be fun to watch in the next 12 to 24 months. But ultimately, like, I do think regulation is going to be coming, especially after the FTX fiasco. I'm even surprised they've kind of let it this linger this long. But ultimately, if the SEC came in hot and heavy when Bitcoin was $69,000, and they crashed the market, like, at the end of the day, their quote unquote mandate is to save retail investors. We can argue if they actually do that or not, but they would be seen at causing, or them being the pin of popping the bubble. And so now they've waited for it to all kind of blow up in everyone's face, and then to be like, well, see, we told you so. And now people are more willing for regulation, and probably even over regulation, when the pendulum swings the other way. So ultimately, I think most of these shitcoin casinos are going to be exchange. They're going to be securities exchanges, because I don't think they're going to be able to drop enough coins for them to remain not a securities exchange.
So, all right, guys, we're about to pass the halfway mark. Give me 1 second. There's like a plane passing by me. All right, so guys, we're about to cross the halfway mark. If you're a new listener here, I'm here joined by Magoo, and we're talking all things Bitcoin and crypto. And we started off by speaking upon his journey into the space, and also some future events that could impact the space. So Magoo, before we go on to the questions, since I'm getting pretty flooded with them. Um, what are some of the advancements that you've seen in the space since you got into BTC, as far as could be anything from mining, could be anything that you're seeing develop right now? What are some things in the process or that have been accomplished that you can say that Bitcoin has changed the world as you knew it back then?
So I'll start off by just talking about something I never talk about too much, but advancement in silicon manufacturing. Obviously, you can't equate all of the advancements of silicon manufacturing to Bitcoin, because really it's, I don't want to call it an arms race, but it's just the advancements in the technologies when it comes to chip manufacturing in general has kind of been like a race to who can actually reign supreme when it comes to chip manufacturing. And you're seeing a lot of that tension boiling over between China and Taiwan. But just even since I was mining Bitcoin in 2010, the chip advancements have been insane, right? Like, you look at Moore's law, yada yada yada, but to actually see it come to fruition when it comes to like chip manufacturing, and we're talking about realistically in the next 2 or 3 years, we're going to be looking at 2 nanometer, 1 nanometer chipsets, for probably most ASICs, which is insane. Like, what that means, 1 nanometer, 2 nanometers, like the distance between resistors on on the chip, right? And nanometers are very very small distance. So the physical science behind that to actually manufacture that is quite outstanding. And I think we are still in this era. We are going to plateau eventually when hard science really becomes a limit on how much power we can pump through of resistors, and how many resistors we can fit into a small area. But I still think even in the next 5 to 10 years, chip manufacturing and technology advancements is going to bring probably the hash rate. I think I made a prediction. I don't. It was somewhere near. Maybe it was like 4 or 5 months ago. I made a prediction that probably by 2027 the hash rate will have doubled. By 2027 from wherever we were. I'll go look back and see those numbers again. But I think that's totally doable, and you're just going to see even, and that's not even with a lot new power gen sets coming online. That's just with chip enhancements by themselves, let alone new power coming online. But then to take it to the other side, obviously chip manufacturing, and then to it comes to institutional on ramps, and yeah, I'll just call it institutional on ramps. So we all know the fucking memes of everyone in 2021 being like, oh, I just talked to 12 institutions, 12 $2 billion institutions, and they're all coming, the Paul Revere style. But that never really ended up coming up to fruition. But the one thing that happened this cycle was the on ramps. The on ramps have been being built and are continuously being built. obviously with FTX blowing up, um, and Binance kind of who knows what's happening with them now, but ultimately institutions were never ever going to onboard via FTX and Binance to begin with. You might have people like Kevin O'Leary saying different, but it was never going to happen without regulation, and they were never going to onboard theoretically billions of dollars, tens of billions, if not hundreds of billions of dollars, using a company like FTX or even Coinbase for that matter, right? Like we're talking about on roads being built by Fidelity. Fidelity offering products not only to institutions but retail now as well. They have their custody business as well, and you are just finally seeing some of these on ramps being built. Like, so we have the institutional side, then there's the whole other side of like the wealth management, which is kind of in between institutional and retail. In each one of those buckets, like institutional money, yeah, that's trillions of dollars. But even even the wealth management money in the United States, last I looked, I think it was a pool of 25-30 trillion dollars. um, and those on ramps are being built today, to onboard that. And once regulation really kind of comes in the next 12 to 24 months, they'll be ready to kind of take that load of people actually coming in, because we had the whole meme of, oh, institutions are coming this cycle. They never came. You had hedge funds come in, you had people looking to make a trade come in, kind of the money managers really far out there on the risk curve, like hedge funds, because they can make those decisions come in. But ultimately we never seen the pension funds, we didn't see the annuities, we didn't see the sovereign wealth funds on the institutional side. We didn't see S&P 500 companies come swooning in like Michael Saylor said they would. They will come. It will happen, but it's going to be a lot slower. But we are seeing those on ramps actually built. And now we kind of just need to see that regulatory framework put in place so that they actually feel comfortable. It is going to take longer. Like, unfortunately, what happened with the FTX, it is going to delay that institutional and that wealth management money. But uh, it will come.
So, Magoo, in regards to custodians and also some multi-sig solutions, what are your thoughts on things like Casa and Unchained? This is a question from the audience. And guys, if you're here as a listener, feel free to hit that request button to come up to speak and join the conversation. Again, we're here with Magoo talking all things Bitcoin and anything regarding to the digital asset space. So yeah, and if you guys enjoy conversations such as these, feel free to follow Because Bitcoin and turn on bell notifications so that you get alarmed anytime we open up a space like this, and hopefully it provides you guys with some value. So go ahead, Magoo.
Yeah. So ultimately, it really depends on your situation, right? On if it makes sense for you to use a service like Casa, or if it makes sense for you to use a service like, let's just call it Coinbase Prime, or what's another one, Bitco. Let's just call it Bitco. In terms of like how you actually want to store your solution. If you are somebody that wants to hold on to your Bitcoin, that is not if you want to hold on to your Bitcoin in a very sovereign way, and you don't want to trade it, and you also are worried about if you get hit by a car tomorrow, and making sure that your family members can actually get access to your Bitcoin, then a service like Casa makes sense. So that's the use case, um, for Casa or for Unchained. If you are a corporation that have multiple people on your board, if you have multiple owners of your said company, it really doesn't make a lot of sense to be storing your coins, in call it a self-sovereign manner for legality reasons. And not only there, if you're even a bigger corporation, some of these other custodian providers offer insurance, where a board of directors will be a lot more willing to say, hey, we feel a lot more comfortable to actually hold our digital assets at a qualified custodian that's regulated and also has insurance in case anything really bad happens, right? And so those are kind of like the two sides of like the best use cases for each one of those individuals. But ultimately, if you're storing yours in a multi-sig solution, you one, it's going to have to be doing that for a very long period of time. I think you're not going to be wanting to trade those, because obviously Unchained and uh, on Casa don't offer like prime brokerage services. Um, and so you're going to want to just hold your keys for decades, and you want to make sure that your family will be able to get access to those if you get hit with a bus, or and you also want to be assured that even if that company goes under, whether it's Casa or Unchained, if they do, that you have enough of the multi-sigs to remove your funds, that you have. Personally, I don't use uh, any of those services. One, because it really, for you to use multi-sig in that fashion, you need to have a very specific use case for that. Whereas if you're just using your 12 or your 24 words plus like a passphrase, there's different situations that make sense. Like I can go down the rabbit hole of what each situation would be that you'd want to use each one of those, but they have their different use cases. There's times in situations where I'd want to use a qualified custodian. There's times when I would want to use my own 12 or 24 words in a passphrase on, let's say, multiple different hardware providing solutions, whether that's a Trezor, whether that's a cold card or a Ledger. Don't use Ledger, it's shit. But like if you want to use a kind of a different fashion or kind of a decentralized storage of your own cold storage. And then there's also situations and cases where you'd want to use a service like Casa or Unchained that's multi-sig, depending on what you're doing with those, right? In the best case scenario, in the best case world, I could see a world where I would use all three of those at the same time, in different fashions with different segments of my corn. I hope that explains it, but like I could talk for days on what each one of those situations would need to look like for me to want to use them.
Thank you, Magoo. Thank you for your answer. All right, I see we have a few hands up. I want to establish some rules moving forward. If we have multiple speakers on outside of our guest, we're all not going to be talking over each other. We're not going to be screaming over the mic. We're going to go one at a time. So with that being said, we're going to go over to Resolute Gatekeeper. Feel free, add a statement, join the conversation, ask a question. The floor is all yours, Resolute.
Hey, thanks for having me on. I want to, as someone who deals with securities law frequently, I want to add some caveat and nuance to what Magoo said. First of all, I'm not your legal or investment advisor, so just putting that out there. As far as the custodian services go, it's kind of noteworthy that so brokerages are treated as custodians when you're putting your money with them. Investment advisors themselves can actually custody your money if they're audited on a quarterly basis. Dealing with the SEC and all these banking laws, there's a lot of exemptions, such as like if you were to buy what's considered a national or municipal bond from another country that is an ally of the U.S., it is exempt from registration in the U.S. So they don't even have to register as a security, even though they are a security. I think that's probably how a lot of what we would consider securities by the Howey test. I think that's how a lot of the cryptos that fall under that are going to be treated. That just depends on how they're operating. The other point I want to make, as far as what Magoo said about maybe buying Bitcoin and other cryptocurrencies from big banks. The CEO of BlackRock was just doing an interview with New York Times and said something along the lines of he thinks he sees a lot of securities being tokenized, and that's going to be revolutionary because of the settlement times. And I think the same thing is going to happen with tokens. They may be securitized. So if you're buying something like Bitcoin or Ethereum or whatever from a bank, I think there's a big chance that you may not actually even be getting the hard asset, the Bitcoin, the Ethereum. You may be buying something that is securitized from them, that is more regulated. So I think that's a scenario that could play out, and I just wanted to throw that out there.
Yeah, that's more in the realm of Magoo's expertise. So I'm not sure how to answer for that for you, brother. Magoo, if you want to go ahead.
I don't know if there was
And
really a question in there. That was more a
yeah,
statement. But ultimately, there's a chance that if you buy it from your bank, that you might be getting a synthetic, which will be a securitized product or offering that's not the underlying asset. You steer clear away from those if that's the instance or the case by 1,000 miles. But when it comes to comparing, let's just call them shit coins to foreign municipal bonds and not having to be registered because of certain alignments with allies, I don't really see that being in the well. It's possible, but realistically, just listening to Gensler and other regulators, I don't see them just allowing like a Uniswap or one of these other tokens to exist like that without being a security. I mean, ultimately, at the end of the day, a lot of these securities, like they don't have to go directly after the underlying token as a security. They could go directly to the exchanges, right? Like if they tell Kraken, Gemini, Coinbase, all these exchanges that like, hey, these are securities and you have to just get your securities license and follow all of those things. You don't even have to say that they're securities or not because they're going to be regulated like them. So we'll see how that plays out. But like, I don't see a world where like an Ape coin or a Uniswap or an Aave or a lot of these DAOs are not like straight up securities. But we'll see in time.
Ava,
I'll
go
jump.
ahead. Floor is all
I'll jump
yours.
in because that actually segues right where I wanted to go, which is kind of if you rewind this space maybe like 4 or 5 years ago, there was a lot less of these shit coins trading on exchanges, such as Coinbase. They have a BCH, Litecoin, Ethereum, and a couple of others. These exchanges have become reliant on the revenues, just the fees associated with trading these shit coins. There's these backdoor deals with Binance and other things as far as listings go. Really, where I want to go with the question, Magoo, is people talked a little bit about the Coinbase bonds, how discounted they are, and my question for you is just like how you can, given that I anticipate, regulation to come down in the next 12, 24 months, Gensler just calling FTT a security and with all the pain that's come from the FTX thing, I see a hammer coming down. And so I totally agree that I think that at some point, this gravy train that these exchanges have had of, pushing shitcoins on their you know, unexperienced clients just shilling this stuff and making boatloads of money on that, that's coming to an end, or at least going to be significantly reduced. So I think that might have some second order effects in the crypto space. So I'm just curious if you can comment on like how you see that playing out with, if the regulatory hammer drops, what are Kraken, Coinbase, Gemini, what are these exchanges going to do? They're just going to lay off people? Is
Well,
this going to have a second order
they're
effect on?
already laying off people, and more layoffs are coming. I'm not going to speak specifically to each exchange, but I know multiple exchanges are going through other rounds of layoffs. Just from me working with people and then just not being there anymore. But whatever the quote unquote regulatory hammer coming down, like it's gonna come down, but I think more importantly, like what that actually is and what that looks like is going to directly affect these exchanges like Kraken, Gemini, Coinbase, whoever, name your other exchanges that are inside of the United States. um, and how that regulatory hammer comes down, whether it's these things being deemed securities and they have to be registered as a securities exchange, or if new regulation comes out, a completely different framework, which I think is less likely just because they have existing tools to kind of go after a lot of this stuff. Um, so ultimately, I think even without the regulatory hammer, I think the amount of money that these shitcoin casinos were making off of retail was on the decline to begin with. The fee compression was already starting to happen on retail. Fee compression actually happened quite early in the cycle for institutions. I remember on Gemini in 2017, you were talking about maker fees of upwards of 100 bips, right? And that was for I think it was their fee schedule was like for the first million of maker. And now you're talking about institutional exchanges where you're gonna be you're gonna be mad if you're paying more than 10 bips. Realistically, like I've seen specific contracts from institution to institution where people are paying five and under for maker and taker. And I've seen some where they're even paying zero because they have other business lines with these exchanges, whether they're market makers or whether they're using their custody products. I've seen trading fees as low as zero. And so that is eventually coming down to retail as well. You've already seen that happen with Strike. Strike came out at the beginning of the cycle and said, Brian Armstrong, kiss my ass. We're gonna why fight to the bottom? We're just gonna go straight there. There's a little bit of like stuff happening there with the spreads. But overall, and as time moves forward, the spreads and the fees are going to go drastically down for retail. And I think most of the money that's going to come from these exchanges is other financial services that they're actually creating, whether that's custody solutions, whether that's futures, whatever that may be. I think the spot money making days are over from retail. And I think that was coming even before regulation. But if the regulatory hammer comes down, and I think it will, not sure what that hammer looks like, but I think it's going to squash that profit making ability even more. And so they're going to have to find that profit elsewhere.
All right,
Yeah,
perfect, perfect. So
totally agree. Just to round that out. So, I hear people talking about Coinbase valuations, like what their revenue was. And for me, and from one of the things you said, from my thinking is that in the future, like kind of looking back on what happened this cycle is like, there's not really a good way to project out into the future what exchanges are going to face. It sounds like a challenging environment. And, for the next kind of part of my question is like, how do you see this affecting the underlying asset? Like, given that there'll be maybe more regulation around shitcoins, like can you see more liquidity flowing into like Bitcoin in the next cycle? Because we saw a lot of that get soaked up this cycle with JPEGs and other
Yeah,
crap.
there will be more liquidity, and I don't think that really has a lot to do with whether or not they're shitcoins or not, because they're gonna drive their own liquidity demands. What I think is going to add the liquidity is once you have a regulatory framework in place, you're going to have the real market makers, like not like fucking Jump Capital or Alameda or Hudson River or some of these like smaller prop shops that are being market makers that are working with dealing with like maybe $1 billion of liquidity a day. And you put this regulatory framework in place, and then you start having the real big boys. You have the Citadels, people that are way bigger than Citadel, and you're talking about moving tens of billions of dollars in liquidity a day for each market maker. And once you create that framework for them, and that it's all, they're just going to be more comfortable with bringing in that liquidity, right? And obviously, you need demand there on the other side to be buying that. And that's what I was talking earlier with those on ramps for institutions and the wealth management industries being built as well. So yeah, every cycle that happens, there's more liquidity than the last cycle. And I just hope that now all this bullshit's kind of finally falling away, that we're actually going to have some real liquidity, not a bunch of ladder trading market makers trading with themselves. Because even still today, a lot of the liquidity that you see on open order books is kind of, I don't want, it's a fugazi, especially in non-American exchanges. And what this is probably going to have another space altogether talking about this, but most of the real Bitcoin that exchanges hands inside the United States doesn't happen over an open order book. It happens in traditional equities. We call them dark liquidity pools. And in crypto, that's essentially OTC desks, even directly to liquidity providers using clearing desks. And there's a bunch of different pricing mechanisms that people use on those type of deals, whether depending on at the end of the day, like I could go to one prop shop or one liquidity provider, and if they have a net long view, they're still going to sell me their Bitcoin. They're just going to add more price to it so that they can position themselves elsewhere to get more Bitcoin. Where if I went to a different liquidity provider and they had a net short out view, that I would be able to buy cheaper Bitcoin from them. And there's all the technology that's being built out now, like smart routing, where you have lots of different liquidity providers being built in to like a smart router and being like 6 protocols. And so ultimately, probably I would say probably like 60-70% of all the Bitcoin that's traded is you don't even see it being traded. What's up, Joe?
Hey guys, great room. I just wanted to echo one thing you said, that even right now, in the end of 2022, Magoo, we still do not have an institutional grade Bitcoin exchange in the United States, let alone the world. We don't have anywhere near the amount of liquidity you would have for a real market. And just put that in size and perspective. There is a firm, and I'm not going to name it, but because we do some work for them, but there's a firm that does minuscule amount of treasury trades, right? They do more volume with short-term treasuries than all of the major Bitcoin exchanges in the United States do in a month. They do it in a day. Okay, just treasuries, just short-term treasuries, right? And obviously, the treasury market is massive. But the point I think you'll get is that like we don't have institutional grade liquidity books. We don't have institutional grade exchanges in the United States, and that is a condition precedent. It's something that's required to get Bitcoin into the 7-figure range, right? If we in 10 years, whatever the amount of time it takes, you need that to occur to actually put that liquidity into the market.
Yeah, you do, right? And that just kind of echoes where Bitcoin's market cap is, though. I wouldn't say Bitcoin's light on liquidity compared to its overall market size. And as the market size gets bigger, you're right, Joe, we are going to still need to have those institutional exchanges actually be there to be able to provide that liquidity in a regulated fashion. Because even like Coinbase only does, well, right now they're only doing about $1 billion a day in liquidity. And like you said, like in the treasury market, that's literally like a fart in the wind.
Coinbase will be acquired once Wall Street really is coming, not this like nonsense people were promoting in 2021. When Wall Street is really coming, Coinbase will be an acquisition target for their custodial solutions, and it will get absorbed, and you'll have big boy order books that finally take precedent.
Do you think that there's anyone out there right now that can actually pony up the money for Coinbase, even in like the very distressed state that it's in?
Well, you'd want it to file bankruptcy, and you want to pick the flesh from the bones, right? You want to buy bits and pieces
Yeah.
of it. I think their order book is crap.
Oh,
I don't think it's even good.
yeah. Coinbase is like their open market book is poopy. They have some other products on the prime side that's a little bit more sophisticated. Let's just call it a smart routing RFQ system, OTC style, with some pretty big liquidity providers. This is better.
It's the personnel, right? You acquire the people. Like those are the real thing you want. You want the people on their back end on the prime side. That's what really has value, because they have specialized knowledge, and there's a handful of people that have that experience and knowledge.
There's not too many people, specifically in the crypto side. There's just not that amount of knowledge, because honestly, like even what I've seen in the last 5 years, a lot of the people that built out these trading systems for not only Coinbase but other exchanges, a lot of them aren't from TradFi. A lot of them are digital native individuals that just don't have that TradFi experience when it comes to like trading desks and trading technology. It obviously this cycle has kind of changed a lot, and you're having those individuals come in. But yeah, you kind of hit the nail on the head that would be, if they went bankrupt, they would want to scavenge that specifically. I don't know if Coinbase will go bankrupt. Maybe, there's other people that go bankrupt before them.
For
That
sure. But if all the bears are correct, and next 2023 is a brutal year for the equity market and everything else, I am very skeptical that Coinbase makes it through. I think you're probably right. They probably do, but it's going to be
yeah,
tough.
there's a lot of well, if you want to talk about assets under management, even though it's not really AUM, BitGo's the biggest custodian there is. um, that actually control the keys. Fireblocks being the biggest, but that they're not really deemed custodians legally. They're not a qualified custodian. They're exempt because of the way that their technology is built. BitGo's the biggest, I believe, with having the most AUM, even bigger than Coinbase. Um,
Hey, sorry, but go ahead.
but yeah, there's going to be custodians that go bankrupt. Like one of the custodians that I think might actually be sold is Genesis. Genesis they bought a custodian solution out of the UK a few years ago, and that's part of the Genesis stack. They have like the derivatives, they have the lending, and then they have the custodial business. And I ultimately see that they might want to shop that custodian business out specifically to maybe a TradFi company would buy that. Also, did was it Goldman that just bought, or who was it that just bought Celsius's custody solution in the bankruptcy?
Oh, was it Morgan
Yeah,
Stanley?
it was one of the TradFi companies that bought the custody solution from off of Celsius's Chapter 11, if I'm not mistaken.
Yeah, we got
What
a bunch
about
of hands up. I just jumped up for a second. I wanted to comment on something. You mentioned, you don't know what the regulatory hammer is going to come down on, and to me, like I'll just state this for my own personal belief. I think that the SEC is recognizing finally what many people have known for years now. You can't do this on a one-off basis. And my friend Leonard Cohen was just giving an interview with Decrypt magazine. He's like one of the crypto lawyers that represents a good amount of these shitcoin companies. He believes in some of the things he's hearing, and he's saying this publicly now, that he thinks that into 2023, we're going to see litigation advance against the exchanges. He thinks that that is what FTX has paved the way for. So if you do see litigation advance against the exchanges, that is a game changer, right? That's finally going to disrupt this industry. One-offs against certain projects, one-offs against Kim Kardashian for promoting some shitcoin, that doesn't do a damn thing. That's a slap on the wrist. But if there is major litigation filed and advanced against Gemini, Coinbase, Kraken, Binance US, that will be a game changer. And if that happens, yeah, buckle up, because it's going to be a big deal.
That's what I always thought was going to happen, Joe. Like even at the beginning of this cycle, because I just looked at it logistically, like you said, like going after one-off projects, even if they're successful in the Ripple case, and they use that as like a kind of a framework of going after other individual companies, like other token issuers. It's just a losing battle. Like literally, you can shit tokens out faster than anything. Like if they, and that's why I always thought at the very beginning, if they were ever going to actually want to do anything, they would have to go to the exchanges. And what that would look like in terms of whether it's straight up litigation or there's a cooperation, the only way that I ever thought that they'd be able to put a wrangle on that was working or suing or whatever you want to call it directly at the exchange level.
Suing. They've had this bullshit refrain, pardon my language, for the last year and a half. Come in and register and work with us, and all the exchanges have told them to go pound sand. We're not coming in. Why would we do that? Especially when we don't think we're dealing with a fair-handed actor. Which they're going to delay and avoid facing any sort of exposure that would come with trying to have a dialogue with the SEC. So I don't know if you guys remember that like late night tweet storm Brian Armstrong did one time, where he was complaining about the SEC when he tried to broker some deal with them, and he said they weren't negotiating in bad faith.
He sued them, didn't he?
Well,
Tried suing them.
Yeah, eventually he did, but this was something different. He went up and sort of went rogue against the advice of his attorneys and just started criticizing them publicly, which is a big mistake in my opinion. But in any event, it doesn't really matter, because at this point where it stands right now, there is an active complaint the SEC has filed, where they have labeled in the Insider Trading Act case against those two brothers at Coinbase 11 different tokens as being securities. And guess what? to this day, they still trade on Coinbase. Those same tokens trade. So this just tells you the exchanges just have gotten to the point where they're just like, I don't care. Unless you're filing suit against us and we're going to play chicken with you, we're going to continue to do this. We're going to continue to sell unregistered securities, and we don't care. So either man up or, we're going to keep acting like this. And I think that maybe the FTX is going to, the FTX debacle and blow up is going to incentivize them and push them in the direction of actually doing something against these exchanges.
Yeah, no, I completely agree with that, and that's what I thought was always going to happen. It's actually taken a lot longer than I thought it was gonna happen. Obviously, regulators and government in general moves incredibly fucking slow. But also, at the end of the day, like even just looking at Gemini, like Gemini's earned product, like BlockFi got sued for 100 million for that exact same product. And so ultimately, like you're going to see suit on Gemini for that earned product, whether they get that 900 million back from Genesis or not. That product is probably going to go away, even if the customers do get that money, and there probably will be sued for probably $100 million. And that's like, as Gensler stated today, this is just like the tip of the iceberg of stuff that's going to come down.
Hey guys, I got a DM from a Celsius creditor, and he informed me that Mike Novogratz of Galaxy Digital had bought an Israeli GK8 custody from Celsius. So I hope that answers anyone in here that had questions pertaining to Celsius. We'll go to Vestige and then Good Guy, and then we'll wrap it up, guys. With Avid and Resolute. So Vestige, if there's any question that you want to ask Magoo or Joe Carloser, feel free to go ahead. And Joe, I'm not sure if you heard me with my brief introduction to yourself, given that I had cut off. Were you able to hear me by any chance, sir?
No, I didn't hear you. I'm sorry.
Oh, okay. Yeah,
Twitter
so
Spaces sucks.
yeah. I've been kicked off about 3 times today, but anyways, I'm King Wabi. I've been in Carter Circle for almost a year now. I'm sure you've heard me go up on his spaces back in the day, so it's a pleasure to formally introduce myself to you in this manner. Feel free to come up anytime. Whenever I host these spaces, could be people such as Magoo that are very knowledgeable in this space, or sometimes even I'll host other traders. Next week I've got Trader XO, and also we have someone from Wall Street coming in. His name's Holder of the Fire. Been in the game for about 2 decades now, and sometimes I'll have more of a crypto based space where I'll have protocols that have like a 2 to 3 year release time frame to come up on the space, and you're free to you're free to go into those spaces as well. I'll welcome you and anyone else with open arms. You can ask them any questions, the hard questions, and I have no bias. If you want to come up and ask the hard questions to these protocols, feel free. But I'm just like a little bit of an FYI. I'm definitely not like gonna bring like some low cap shitcoin or anything like that.
Thanks, Wabi. I appreciate it, and thank you for having me up.
Yeah, man, it's a pleasure to hear from you, man. I always enjoy it when you and Carter speak during market talk. So Vestige, feel free to add a statement or ask a question to Magoo, brother.
Yeah, I was just going to kind of touch base on what you guys are saying. Even if some of these companies get purchased, like these exchanges, I wouldn't be surprised if some people have already circled in and kicked tires on, say, Coinbase or Gemini or other stuff. Like there's got to be, I think, higher people that might want to buy them if they fall. And I kind of agree with what you guys are saying. If you're buying a company like that, you're buying their data, their people, their team, and obviously their tech and whatnot. And you can use it for other things. And as far as regulation, I think moving forward now that we have the whole, we're kind of going into Act 2 of the whole SBF thing now that he's caught and been snitched out by everyone. I think as the court cases kind of like develop and they go a bit longer, you're probably definitely going to see regulation swoop in a bit quicker. Everything you're seeing right now, and I think you kind of touched on that too. All these other people are, the second everyone are angry about this now, and I think they're really trying to push a bill forward. So you're probably going to see something like, I think we're going to see regulation a lot sooner than we expect now.
I think the first thing that they have, they've even signaled this, at least the Senate Banking Committee, the Stablecoin Act or some type of a Stablecoin Act. That's the thing that I think that can get pushed out of the door first, and at least when it comes to a bipartisan um, bill, because there's still a lot of, for lack of a better word, bullshit between the Democrats and the Republicans of getting what they want in so-called of like a crypto bill. But I think there's a lot of bipartisan agreement when it comes to stable coins. So I think I would be shocked if we don't see a stablecoin act or something at least being passed around in the first quarter of this year, because there, at the end of the day, a lot of this stuff with these unregulated exchanges, they've kind of peripheralated mainly because of unregulated stablecoins, right? Because if anyone's been around since 2017, those were the main liquidity settlement mechanisms. Because a lot of these unregulated exchanges couldn't get a bank account anywhere on the planet because of their line of work, and so that they were using these stable coins to act as liquidity and settlement tools. And so I just see that there's going to be, before anything else, there's going to be stablecoin act that maybe it won't get passed right away, but they're going to really try to push for that, I think.
Good
Yeah, I
guy.
agree.
Good guy. Go ahead, brother. The stage is all yours.
He might be away. He might be away. I'll jump in real quick. Last question, Magoo. With Fidelity offering or supposedly having an upcoming crypto portal and being able to purchase through your 401k or your IRA, how do you see potential passive flows into Bitcoin kind of acting as maybe like kind of a little float on the price of Bitcoin, whereas in the past, it's like mostly spot buyers that probably drive the price with kind of regular purchases. Just curious if you could comment on
So
that.
ultimately, spot prices do control the market. Like, you can suppress a lot of things with paper derivative markets, like the CME and other things where you can settle in dollars and not the underlying asset itself. But even like, I'll give you this example. In some of these dark liquidity pools that we're talking about, whether it's an OTC desk or directly with liquidity providers, or directly with miners, for that example, when big trades happen, like I'm talking about like $100 million trades, $200-300 million trades, that finds a way of working its way into the market. Even if I say, hey, I want to buy $300 million of Bitcoin, what's the price right now? I don't even know. Like, let's say 16,500, and you say, okay, I'll sell you that, but you need to pay me $17,000 because I'm giving you such a big order that you wouldn't be able to get $300 million of Bitcoin anywhere else. Like, because that's how much the market would move up. Like, that price filters its way into all the other open order books around the system, even though it's done in a dark liquidity pool. And same with other non-direct trading exposure with Bitcoin. So even if you're dealing in MicroStrategies stock, right? Because that's basically a vehicle for investing in Bitcoin, that you're not actually buying the underlying asset. If there's a big deal that happens in MicroStrategies equity, and a big company comes in and buys 10% stake, at the end of the day, that's going to filter its way into the Bitcoin price, because ultimately someone's buying and wanting to get exposure to Bitcoin at a very large portion. And that ultimately, whether it's through the word of mouth or just through kind of the mechanisms of the market, it will work its way into Bitcoin. Now, bringing this back to the original question of like, where do I see passive flows coming from? Like, I guess just maybe it's just to support the market, or just the passive flows that are going to continue to happen. So obviously we're going to continue to see kind of the plebs and the hodlers continue to do their DCAing over time. That's kind of just a set in stone type of thing. But where I really see the next massive amount of capital coming into this space is actually not from the institutions. I think it's probably going to be from the wealth management side. Because ultimately, like when it comes to capital allocation, you have kind of three main buckets. You have institutions that can be anywhere from S&P 500 companies, that can be annuities, that can be pensions, that can be sovereign wealth funds, a whole slew of institutional money, and they deal in very large orders, and they have a lot of money. And then on the other side, on the far other side, there's retail, where there's a lot of retail, and they have very small money, but there's a lot of them. And so there's that bucket of retail money. And then in between those two, you have the wealth management industry, which is made up of high net worth individuals and ultra high net worth individuals. And even in the United States, last I looked, I think there's between 30 and 32 trillion dollars of assets that is basically controlled by the wealth management industry in the United States alone. Um, and when it comes to allocating to new assets, when it comes to being exotic, you have your first movers on the institutional side, which are your hedge funds and people that have mandates that allow them to be more risky, right? Obviously, pension funds or funds that have bond mandates, you can't, even if they want to allocate to Bitcoin, they can't. So those are the first movers. We've seen those guys come in this cycle. But then the other people on the institutional side, they're a lot slower to move over, whether it's the pension funds, whether it's the insurance funds, the annuities, sovereign wealth funds. Those are a lot more conservative money managers, and they're going to take a long time to kind of see a market develop, see regulation develop, and then finally them actually willing to move in. And it works in tandem because they actually need the market to be a lot bigger to even enter. Because what Joe was talking about, some of these money managers, is like, at least when we're talking about the bond market, they can't get any size of a position in Bitcoin because there's no liquidity. They need a bigger market. So for all those reasons, most of those institutions are actually going to be the last movers. And we've seen the retail be the first mover, and not any more money is going to come in from the space from retail. Like, I ultimately think the story of money coming into Bitcoin, like, we've passed that retail era now. Like, that money's still going to come in, but it's not going to be more retail that takes us from 16K to 160K. What I think does that is that slot in the middle of wealth management money, where they're not the first movers, but they're not the last movers. And they have a very large chunk of capital. Like I said, $30 trillion. And a lot of the IRAs, a lot of the FAs, they can be very maneuverable when it comes to allocating their clients' capital, and they can make those decisions. Sure, there's different deals that have to happen. The IRA market's really fluid in terms of vertical integrations, and so there's a lot of things that you have to do to integrate to those IRAs and those wealth management companies, because they like to silo themselves off pretty well because they like the sticky capital. But that's where I think the next $1 trillion is going to come from. So I think that sector is where the money is going to be coming from, up until the next cycle. And to take us to that 100K price zone, I think majority of that money is going to come from that industry. And that 30 trillion that I was talking about, that's just the United States. That's not the wealth management industry in Canada, Europe, England, Australia, everywhere else where all these wealth management industries exist as well, that have a lot of capital. And so ultimately, I think that's where a lot of the capital is going to come from over the next 4 or 5 years, particularly.
Magoo, I want to thank you for your time, for coming up on my show. I've really enjoyed the last hour and a half. It's been a great conversation with you. I've been trying to set this up for a while. Thank you so much, from talking about your background and how you found the space, and also more of the legality sort of stuff and how the space can move forward. I want to thank you, Magoo. The Because Bitcoin community loves you, and Mr. Carlesser, thank you so much for coming on as well. If you're up for it, Mr. Carlesser, I'd like to host you sometime next week. I do these at 7 p.m. Eastern time, so I'll reach out to you after this space regarding that. I'd love to chat with you. And good guy, you came in a bit late. I know me and you have chatted throughout the summer and in the early fall. What's going on, brother? I know it's been a while, but we do have to wrap up here. I'm sorry, guys, but it's been a pleasure. I'm sure 3, 4, 2, maybe a month from now, we'll have Magoo back on here, and hopefully, this whole smoke regarding Coinbase and Gemini and Binance is somewhat resolved. And for you guys in the crowd, thank you so much for participating in another edition of Crypto World Radio. It truly means the world to me that you guys have tuned in over the last couple of weeks since I started this with Because Bitcoin. And I want to tell you guys that I love you. I appreciate you. God bless you. And if you enjoyed spaces such as these with guys like Magoo and Mr. Carlos are jumping on, feel free to follow the Because Bitcoin Twitter page and turn on bell notifications so you can get a little reminder that I'm hosting a space. And also, Big Brandon will still be doing market talk via Twitter Spaces Monday through Friday at 4:15 p.m. Eastern Time, sometimes a little earlier than that. And with those spaces, he usually gets more into the broader macroeconomic discussions. He's more well versed in that than I am. I'm still trying my hardest to become more informed in that regard. So hopefully, with more spaces such as these, with guys like Magoo and Mr. Carlos, I can learn as you guys are learning along as well. In this world of crypto. So again, guys, also we have our Discord link up on the nest if you want to join a vibrant community with individuals that are passionate about the equity markets and the digital asset space. Feel free to join. There we have almost 1,000 members, and yeah, it's pretty popping in there. I've made some friends, so that's always great. Magoo, again, it was a pleasure to have you here. I look forward to the next time that we speak, brother. I appreciate you, man. Thank you. God bless you,
Yep,
man.
thanks for having me on. We'll have to do it again sometime.
For sure, man. If anyone wants to give any last words before we close the space, feel free. Good guy. I know you wanted to say something, so go ahead, brother. Go ahead, and I'll close it.
Yeah,
If
I
you
was
want to
just
say
going to
something, man.
say, I just wanted to ask Magoo's opinion on the number one threat to the retail consumers, but we don't have time for that discussion. So, damn it, Magoo tagged me in some goddamn tweet, and now I literally have to shut all my Bitcoin operations we're building out down right now. He literally got me banned in my home country by tagging me on a tweet. So, as always, thank you, Magoo, for thinking of me and keeping me on the pulse of the shit I'm supposed to be on.
No,
So
the
thank you.
short answer to your question, though, good guy, is that the most dangerous thing to the retail consumer is themselves.
Not GameFi. or GameFi too.
Web 5.0, dude. It's Web 10.0 and Web 20, dude. That's the biggest threat, man. But hey, at least we can partake in our favorite hobby, which is bridging from Doge Chain to Avalanche to purchase Snickers bars, right? That's a joke that we like to throw around here at Because Bitcoin. So, anyways, guys, thank you so much again. Thank you for partaking in this more relaxed kind of interview, sort of discussion with Magoo. It's been a long time coming. And with that being said, thank you guys so much. I'll be having my next edition of Crypto World Radio tomorrow at 7 p.m. Eastern Time, and we'll go over this sort of interview one-on-one stuff, talking about BTC and crypto with Big Air Mass. I know you guys love them, so it's going to be more of a different style of space. So with that being said, thank you all so much. I'll see you tomorrow. Be safe. Good morning, good afternoon, good evening, wherever you are. Take care, and God bless you.
trading current is just math. It's just math. It has a 95.45% hit rate when we deviate outside of CP2 and CN2. All you had to do is recognize that 95% of the time when we get over here, under this blue line, we get some sort of mean reversion. So let's just assume you long right here. 95 out of 100 times, when I buy this, I'm gonna get some sort of bounce. It's just math. Look what would have happened as we move up. Look at the bounce that came after. And now look where we are. If you had just blindly followed the current, you take all emotions out of it, and you say, I'm going to trust the statisticians, you would have bought Dow Jones somewhere down here under 30,000. You know, depending on how you want to measure it from absolute top to bottom, 20% move. We also have multi-time frame alerts. You don't even have to be at your computer on TradingView. You can ping your phone. Now, the current has some really awesome features, and I would urge you guys to join our Discord to get access to it. We give it away for free as a tool to the community. It's just math. There's really no need to overcomplicate things, not even in the slightest.